All right, it's all going to start from this master screen right here. All right, everything that we're going to do for deal capture is going to start here. Coming out of trading and going into, which let me stop real quick. I came from the I/O world, and if any of you guys have seen I/O is an incredible tool. But I will tell you that as I'm looking through this, I really like this. Okay? This comes to our contract commitment model, and a lot of people have heard, the CC, the contract commitment model. I really like this. Okay, think of the contract as a big box, right? That's the big holder, and the commitments are what we fill the contract with. Now, we could put one commitment in there, or we could put 20 in there, and that's the holder. The header is the contract. Commitments are the filler. All right. So what happens on this screen, we've got this top, and I wish I was about 2 inches taller for many reasons, but anyway, the top part of the screen is the header. And the header is going to stay static. We're going to fill in our information up there, who our counterparty is and so forth. And the bottom part is our commitment. And that's what's going to roll, and that's what's going to move as we go from commitment to commitment. We have commitment 1 here. If we put another commitment on, this screen would change and flip over, and we put the next commitment in, but our header would stay the same. Our box stays static, and our fillers flip pages of a book like that, right? Now, on a buy-sell, we're always going to have 2 commitments at least, all right? It's a buy-sell, so we've got to have a buy and a sell, right? Seems pretty logical. So we'll put in our buy first. We'll put in where we're purchasing, how much we're buying, at what price. In this case, it's a fixed price, so we're going to agree to, $80-some a barrel, whatever it may be. So we'll put that in. We get all that fixed, and then we go to the sale side. We'll add a new commitment. We'll flip it over to the next page, which will be blank. We'll fill it in with where we're selling it, the volume we're selling, and in this case, again, a fixed price, so we'll put in our fixed price. So it's like I said, I was really worried when I kept hearing about the problems with we're very nervous about the contract commitment model. But from what I've seen, examples I've seen, I'm really, really encouraged about that. So let's see what we got next. This is an excellent tool right here. Today, we have a list of commitments. But every time you go into a commitment, you lose the view of all the other commitments because the one commitment dominates the screen, and you've got to try to work it around. This allows you to see all of your commitments up here in this blotter. Did I use the right terminology, blotter? All right, I'm getting into this. All right, the blotter. And when you highlight that blotter, it gives you the information of that commitment below. So you can work on it while you're looking at the others, because I can tell you time and time again in the past, I have put in a delivery side, right, or a sale side, and have gone in to put the other side in and have put it in the exact same direction, and had to go back because I didn't see what I had already put in. I mean, your mind's working, you're doing things, you're looking at other stuff. So this way you can keep track of the commitments. I mean, imagine if you did a buy-sell with 10 and 10, right, which is not out of the ordinary. If you did a buy-sell with 10 and 10, you've got your whole blotter up here that you're tracking, and you know what you're doing, and you know exactly where you are. You don't have to keep flipping back and forth. So again, I really like this tool to be able to see what you're doing while keeping track of what you've already done. So, all right, and here, this is going to get me to one of the parts that I think is extremely powerful. All right, I hate just, I'm going to throw that out there. This is very powerful. But these validations, okay, I'll get to that in a minute. As we go through and we fill in, we've got our contract header all filled out, and we go through, we put in all of our pages, which are our commitments, we fill that up, we fill our box up, and we're done. And we're ready to go ahead and validate the deal. There's a few fields that are going to be, I'll use mandatory, it's right up there. It's going to be a hard stop, right? It's going to say you cannot go any further unless these are taken care of. So there are some mandatory fields in there, and there's some discussion on highlighting those, making sure we know what those are or not. But capturing all the mandatory fields is one. All right, now that's obviously because you have to have certain things in there. You know, you got to have your counterparty, you got to have price in there, you got to have location, volume, grade. There's a handful of things that you must have. Otherwise, you really don't have a contract. You don't have anything to validate. One commitment captured. If you don't have a commitment, you have an empty box. Right? Empty box doesn't work. Got to have something in the box. Got to have something on the contract to make it actually a contract. Start date is earlier or equal to end date. I mean, that's common sense, right? But it happens. We put in the wrong year. And a lot of times it's the year that happens. Let's see. For interbooks, the strategy's got to be different. I mean, if it's not a different strategy, it's not an interbook, obviously. Buy sells. Like I said, you got to have one and then the other. You got to have one go in one direction, one go in the other. Receipt, delivery, buy, sell. And then the commitments have to fall within the contract dates. I mean, it's like taking your filler and you missed the box, right? It fell outside the box. It's got to be inside the full contract, inside the box. So those have got to happen. Now, let's see, real quick. Am I talking too fast? I feel like I'm speeding up. I'm getting excited. All right, so there's a few others. What's that? There's a few other validations that they'll let you know that you did something wrong, but it won't be a hard stop. And some of these are the buy sells have the same delivery frequency and the buy sells have the same volume. Now, that doesn't always have to be exactly equal, right? If it's not exactly equal in the volume, then you've got more risk exposure that you have to handle. And that's okay, right? But it wants to let you know that, hey, you're going to be out of balance here, so you may need to do something. You need to put the wrong volume in, you need to put a hedge on, so forth. This delivery frequency, we do a lot of deals that are not the same frequency. I may deliver 100,000 barrels at one time, and then I may tell the counterparty, I want to take 25,000 barrels per week back over 4 weeks. And that's just because my view of the market is it's better to give it now and get it back periodically. So it just depends on how you want to structure the deal. So it warns you to say, are you sure? You can say, yes, I am sure, good, I go forward. Price fixed greater than zero. Personally, I don't know. That to me, that's kind of, I don't want to give it away for free, but it's just a warning to say, look, got to put a price in. And then the quantity is less than 1 million barrels. I think that's one of those manual of authorities, one of those security things to say, this is a big deal. Are you sure that you want to do a deal this big? And then contract has already been scheduled. This is something that, the personal relationship between the trader and the scheduler is very important here, because the scheduler may be working on something else. And they may have already committed to a lot of things with the other scheduler, scheduled a lot of stuff, it's all going out, everything's taken care of, and then you come back in and mess it all up by talking to the other trader and do something different. And this just tells you, hey, your scheduler's already made some arrangements. You need to go talk to them and make sure that you guys are on the same page. And that's all that is. And just to make sure that you know what you're doing, right? I mean, traders, we're a bunch of flunkies. We're not the smartest people on the planet, so we need to have reminders, right? So, and what I like about this, and what I was getting to about how powerful this is, today, if we have a warning, it says, you have errors. Thanks. So you go back in, you try to find out where your errors are, and you fix them, and you say, did I get it right? It's like playing, the slot machine. Yes, I got it, Or no, I didn't get it. This shows you what your errors are, and it allows you to work on your errors while right there in that same screen. Another screen's going to pop up and say, you need to fix this. And you can fix it right there, right then and there, validate it, and move on down the road, which I think is, again, whoever came up with that is a genius. And I think that's about it for the deal capture side. Once, we got it all in, it's all buttoned up, the box is full like we want it, move on. Okay, the question is the difference between a buy-sell and an exchange. And for me, I think that the biggest difference is the term. and then, of course, some of the pricing and the balancing that goes along with it. A buy-sell is typically a spot deal. You have a fixed volume for fixed volume, location to location, price for price. Once we are delivered, we are done. And we can do another one later on, but that deal is in conclusion. An exchange is more of a long-term, evergreen, if you want to call it, continually rolling deal, where you say, I'm going to pick up this quality and quantity from you at this location, and I'm going to give you this quality and quantity at another location. And there are differentials that you pay between that. So you can say, my base is Pasadena M-grade gasoline, right? And anything over that or apart from that, there's a differential. Plus, you decide, I'm in the seat of power in this case, and I'm going to make you pay for giving you a barrel where you want it. So it's more continual than a buy-sell as well. So.
One thing I want to add on the difference between buy-sell and exchanges is exchanges we keep up with the imbalance. It goes in the physical forward book. The buy-sell differences, as Jay was saying, there is differences on buy-sells. We don't really track the difference on the buys and sells within the forward book, but Jerry, when he gets to ops, they do keep track of it because those barrels have to be scheduled back the next month. So there is some subtle differences. Some have zero value to them. Some have full commodity price. So there's a lot of exposure on exchanges that you don't have on buy-sells necessarily.
All right. Yeah, exchanges, there's people who are, their entire job is dedicated to watching the balances on exchanges. And they determine whether they want to pull more or give more on that exchange based on their view of the market. Okay, the question is on the buy-sells, once the initial agreement is fulfilled, completed, do you have to write a new contract or can you just extend that? And you can do it either way. It depends on really the relationship between the traders is a big factor in that, and the trust they have with each other. Can we increase this volume a little bit? Can we extend the date range a little bit? The other thing is your view of the market. If you think that this is a great deal now, but when they come to extend it, you think, nah, not so good, you'll renegotiate that. But if you think it's a great deal, then you say, sure, we'll extend that out for as long as you want. So it's just there's just varying factors on that. Personally, I would add a new commitment. I would make the contract bigger, extend that contract out, and I would add more commitments to it. Sure. Okay, the question is that Endore's limit for commitments to a contract is 50. And what do we do after that? I would say that might come into play with exchanges, and I believe there's actually some discussion around that about linking different deals with the same reference contract number. I'm not 100% sure on that, but that's where I believe we're going. But as far as buy-sells go, we really are not in any danger of reaching that because from a trading perspective, it's very, very spot at the moment. We don't do a lot of long-term deals. The question is the buy-sell a different instrument type. And I'm going to have to defer to somebody because I try really hard not to get into what are the instrument types with the folks. Dan, can you help me out on that? Okay, so it's a COM buy-sell. It's a user-defined instrument. COM buy-sell. Okay, thank you. Yeah, if I start getting into COM this and COM that, Dan knows he's been in several meetings with me. I get confused and I get angry. So. Anybody else? Great. Thanks. And I'm going to pass it off to Derek.